Welcome to Bloomberg Quint. We're in the Bloomberg building in Midtown, New York, and I have with me Abby Joseph Cohen. She's Senior Investment Strategist at Goldman Sachs and President Global Markets Institute at Goldman Sachs as well. Now, Abby needs no introduction for those of you who've tracked markets for a long time, but if you're new to the markets, she is one of the most renowned voices on US and global equities. Abby, it's a delight to have you here on Bloomberg Quint. I'm going to first start by asking you how you assess the US economy at this point in time, and the one question that everybody's been asking for the last several months: do you expect that the Fed will hike rates in December?
The U.S. economy is doing reasonably well, although that may come as a surprise to people who pay attention to the political debates in the United States. Economic growth now is probably at about 2%, not bad for such a large economy. Unemployment rate is now below 5%, and we are seeing that incomes and wages have been rising. So that's good news in terms of the durability of economic growth. This is a Fed that would like to raise interest rates, but not before they need to. And among the things they're looking at, not just domestic conditions, but also global conditions. And this has been, I think, a factor in why they have waited. Our expectation is that there's a better than 50% chance that they will raise interest rates again, but likely not until after the election. So that would be the December FOMC meeting.
You spoke of the global scenario, and I think there is some data now that seems to suggest that the expectation for the increase in consumer prices across the world is now at about 1.3%. That's the estimated increase in worldwide consumer prices. And many experts are saying this, in a sense, wards off any threat or potential fears of disinflation or a recession of any sort. Would you agree with that assessment? First, for where we are in the inflation picture globally, and then, of course, inflation in the US isn't moving much either.
Many central banks have a target of inflation of about 2%. Right. So we're still below that. One of the key elements over the next few quarters will be what happens to energy prices. We have seen, for example, in the United States that CPI, our consumer price index, has been held down by lower energy prices, but as they move up, we would expect that the CPI would start to move to about 2%. Core inflation is something the Fed will spend much more time looking at, including the metric in the United States that's called the deflator for personal consumption expenditures. We're not yet at 2%, but we have been moving higher.
But you would agree that the threat of a recession globally at least has been warded off for now, or are you still very concerned about the systemic weakness in the Eurozone?
Our economics team, based in Europe and elsewhere, is not concerned about there being another slip into recession. What we do see is that monetary policy in many different countries is trying to be very stimulative, and what we'd be looking for is movements on fiscal policy. We think that this has really been something that has been unnecessarily absent in the discussion in the United States, for example. We are now hearing many more calls for an increase in infrastructure spending. In Europe as well, there's less discussion about the so-called Maastricht constraints and much more discussion about what could and should be done for governments to increase their spending to enhance economic growth.
Abby, that's a conversation that's been going on for several years now. In fact, we've had central bankers talk about why governments aren't picking up their fair share of the load across the world. Let me focus a little bit on the US, because we're hot off the first debate, and it's not fully clear what the economic policies of both candidates are. And I wanted to know what your assessment is of, I want to ask you who's going to win, but what the likely economic scenario will be given a potential Trump presidency or even a Clinton presidency.
We have much more information about what a Clinton presidency might look like. She has been much more forthcoming with potential details. When we look at what they have provided and go to a series of nonpartisan think tanks and experts on tax policy, what seems clear is that Mrs. Clinton's proposals would be much more balanced. Yes, some increases in taxes, particularly for upper income individuals, but we also know that the spending is largely matched with those increases in revenue. Not so much the case for Mr. Trump, where most of the outsiders are suggesting that the national deficit would increase tremendously under Mr. Trump's proposals.
You said right at the beginning that the expectation now was that there's a 50% chance of the Fed, doing another rate hike in December after the elections are done. Do you think that that chance stays the same if it were Donald Trump to become president, or do you think there is a change in the way the Fed will look at the economy at that point?
Despite comments that have been made by some politicians, we think the Federal Reserve tries to make their decisions in an apolitical manner. Other than trying to avoid the election itself, we believe the decisions will be made based upon the economy per se. Now, what is already built into the market is the expectation of another rate rise, hence more than 50%. Our team thinks that the odds are closer to 65% because they take a look at an economy which is probably accelerating. We are seeing some strength now because of inventory rebuild, and the consumer is looking better as well.
Okay, that's the big picture. What is that going to mean for the US equity markets? Mr. Trump himself has been quoted as saying there is a bubble in the US equity markets. I don't know if you agree with that, but I'd love to hear your views.
We do not agree with that.
Okay.
When we take a look at valuation models, we're much more concerned about bond markets, where we think that interest rates in most countries are too low. Let me point out that in any number of countries, including those in Europe, interest rates are negative.
Yes.
That is not the case in the United States. The Fed has made a very conscious decision beginning during the financial crisis not to move to negative interest rates. So we have positive interest rates in the US. They have been moving higher. The yield curve has been steepening because we see that investors are expecting at some point that the Fed will raise short rates, and the intermediate and long yields have already started to drift up. With regard to the equity market, we need to look at a combination not just of interest rates, but earnings, return on equity, return on capital. And when we do that, we think that the U.S. equity market is roughly at fair value based upon earnings for this year, but the equity market is always a discounting mechanism, one that looks into the future, and based upon a positive outlook for 2017 and beyond, the U.S. equity market, we think, offers good value.
Do you expect a repricing of emerging market investments if the Fed were to hike rates in December? I think there are many different views out there. Nobody's able to fully assess what the scenario will be like, but you see more money rushing back to the U.S.?
We have seen emerging markets perform quite well since the summer. I think the average is up something like 12 to 13%, and we think that this is likely to continue. Keep in mind that there's been a great deal of movement into the emerging markets from investors in the developed markets who are feeling more comfortable with their home markets. You know, the very strong correlation is that if a home market is performing well, the investors there feel more confident and they're willing to take on more risk, number one. Number two, we believe that these flows and the more stimulative policies that we're seeing in a number of the developed economies is to the benefit of emerging markets. We've seen a great deal of money go into India. India is now overweight by most investors who specialize in emerging markets, and our research team think that this is appropriate. Strong economic growth, a good long-term outlook for India suggests that that's a good place to be. Our team would also suggest at this point an overweight in China. And this is against the grain of the consensus. The consensus is now less underweight than it used to be 6 to 12 months ago. Our team is suggesting an overweight. And the other area where we're seeing a consensus move in a more positive direction is Brazil, where investors are saying it's gotten cheap enough. So it becomes a question of what's priced in to the market, and investors, by and large, who specialize in emerging markets are saying there's an opportunity there because of the valuation.
That's interesting you've brought that up. It suggests that your team is now more confident about the Chinese government being able to sort of balance their restructuring process that's gone on. Brazil's been through so much political turmoil, and if both those markets look attractive, then do you think fewer flows will go into markets like India, where everyone's been overweight, and the conversation now has moved towards, are we also overvalued?
Well, all I can say is what our team is recommending.
Sure.
And they are recommending an overweight in India, an overweight in China. but we are seeing some other investors becoming interested in establishing larger positions in some of these other markets as well.
Okay. You mentioned, I think, in the beginning of the year, in a series of interviews, that you were expecting the S&P 500 to be at about 2,100 by the end of the year, and of course we are right there. You said that China would not, undergo a hard landing, and that has been the experience. Though the first 3 months of this calendar year seem to suggest otherwise. The markets were freaked out a little bit about China. Crude oil prices have recovered a little bit. So all the calls that you made at the beginning of the year have turned out to be, absolutely bang on, and no surprises there. But what interests me is that whilst all of these strike a note of confidence, we've also seen a big rally in gold prices. And that sort of offsets or contradicts the confidence that people may have in the underlying economies and the equity markets. What explains the rally we've seen in gold?
One thing I would mention here is that it tends to be emerging market participants, particularly those in India and China, who are most interested in gold. Gold is not a major asset category for institutional U.S. investors, yes. But it is viewed as a store of value, particularly for those based in emerging markets who, for cultural reasons and also for risk avoidance reasons, like gold. I tend to look at it as an industrial commodity and not much more.
So you're not reading much into the fact that people are putting more money into gold as possibly, some sort of uncertainty about where the world is headed, because you alluded to the large amounts of money that currently earns negative interest rates or earns no money at all, right? And there is a great degree of fear because this is the first time the world is seeing something like this and nobody knows where it will end. Is gold a reaction to that? Is gold a reaction to the political uncertainty in the US?
Yes and yes.
Yeah, okay. All right. So well, that's the short answer. Do you expect, or what do you expect will be the outcome of such large amounts of money earning no money in Europe and many other parts of the world, including in Japan, where now the BOJ seems to be struggling with even the easing policy?
Yeah, I mean, one thing that central banks have to come to grips with is the idea that negative interest rates may not be such an effective policy. In some countries, it's turned out to be a true folly. So, for example, when Japan moved to negative interest rates last January, one of the things the BOJ said specifically is that they were hoping that this would encourage more wage inflation. Yet it was followed shortly thereafter by a statement from the Japanese labor unions themselves that they were going to be asking for lower wage increases than previously thought because of the negative interest rates. Where we have seen potentially some benefit from negative interest rates, mainly has come through, in my opinion, through the foreign exchange channel. Right. Negative interest rates has led to a reduction in the value of the currency, and hence that nation has become more competitive on a trade basis. That, to me, has been the main mechanism. What we are seeing, of course, are, as you point out, some of these peculiar decisions that are being made because of negative interest rates. It's hard, for example, for those who are naturally savers to put money into banks when the returns are, shall we say, poor or non-existent. And we have also not seen a particularly large increase in borrowing, which had been the intent. And so I think that what we need to be thinking about is a more comprehensive approach to economic stimulus. And as we discussed, a lot of that could come in the form of fiscal stimulus.
And if it doesn't come through as fiscal stimulus, because we continue to see political uncertainty, we've seen it with Brexit, we're seeing it in Italy, we're seeing it in Greece again. What happens next year?
2017 thus far, to our economics team, looks like a year of economic growth. It will be below potential in a number of countries, perhaps not the United States.
Okay.
And that is likely good news. We are the world's largest economy, we're also the world's largest importer. And so if we are strong, that benefits many of our trade partners as well.
Okay, one final question then, Abby. What do you expect? Now, I don't know if your team has put out targets as yet, but since we're only 3 months away from a new year, I'm going to ask you for what you expect will be the year will hold for equity markets in the US, for commodities which seem to have bottomed out, including oil prices, and where you see the fixed income market go. Where do you see rates go?
All right. Quickly for the United States, we see rates higher. We see equity prices higher as well.
Okay.
We think that they move up largely in relationship to the growth in earnings. And we believe that the economy will continue to do well. More jobs created, perhaps at a slower pace than they're being created right now. But we do think that wages and family incomes will continue to rise. And ultimately, that's what gives any nation a period of sustained economic growth.
And some of that confidence extends to emerging markets as well.
Yes.
Abby, thank you so much for your time here in New York, and thank you for speaking with Bloomberg Quint.
Pleasure.